Wouter, welcome to Questioning the Manager. Now let's start with change. It's a driver behind your stock selection. Do you want to explain to investors what you mean by this?
Well, what I mean is I believe that markets are semi-efficient, that most companies are fairly predictable outside of the recessions, and that most analysts do a pretty good job at modeling those companies, and that most investors do a pretty good job at putting a fair valuation on them. That doesn't mean you can't make money as an investor. You can make money as markets go up, and also the fairly valued, fairly modeled stocks will go up together with the market. But if you want to deliver performance that is substantially different from your peers, from the benchmark, I think you need to do something different. And that is why we are focusing on stocks that undergo change. Because like most investors, they're human beings, and human beings, they struggle with change, especially when change is severe and it's disruptive. And so when there is a lot of change, there is a chance that analysts aren't modeling the company correctly, and that investors aren't valuing the company correctly, and so that we get an opportunity to make an outsized return. So that's why we are focusing on companies undergoing change.
So is there a good example of this in the portfolio?
Well, let's take the biggest position that we have as an example, Dollar General, which is a low-end convenience store chain in the US, similar to Aldi here in Europe. And there's three types of change. One, we believe that there's a much longer growth runway for this type of company. We compare it, let's say the 7% market share that Aldi here has in the US to 4% for the entire dollar store space in the US. So we believe that the store base can double, and analysts aren't giving them the credit for that. Second one is the industry is consolidating. We're down to 2 players at the moment, and that is leading to higher margins, higher returns, again, something that the market isn't modeling. And then thirdly, we're seeing a change in the boards with more people that are in favor of capital returns. So we're seeing a pickup in both buybacks and both dividends, which should benefit the stock going forward.
Okay, moving to the US, over the past year the allocation there has gone up. 7 of your top 10 holdings are in the US. Now, some investors might be worried that valuations are getting a little bit expensive. Do you agree with that?
Valuations in equity markets are not cheap, but I think we're at a level playing field for most regions. If I look at the US, we're at 17 times forward earnings. I look at Europe, we're at 16.5 times forward earnings. Look at Japan, we're at 16 times forward earnings. So I think we made a good call last year by having more weight in the US and benefiting from a stronger US dollar. I think today the chance of making an outsized return through geographical allocation is much lower. So on the back of that, I just want to stick with my highest convictions. And coincidentally, 7 of those are in the US at the moment if I look at the top 10.
Okay, finally, Wouter, let's look to the portfolio's yield. It's a growth portfolio, but it has a relatively high yield for a growth portfolio. Is this something you hope to continue, and why is this?
Absolutely. I think we're in a lower growth, lower interest rate, lower inflation environment for longer. And so there is demand for yields. We can provide that yield. We're yielding about 2.5% at the moment. And we're doing that by generating that yield in the underlying portfolio. And even if we would fall slightly short, then we still have 2.5 years of dividend reserves, so reserves that we've build up in previous years to cover that dividend going forward. So I think we're in a great shape to continue to pay out this dividend and potentially grow it over time, but that is a decision for the board.
Wouter, thank you.
You're welcome.